during the 2007 is financing costs were quite low. Credit spreads, which is the premium you pay for credit risk, was also among the lowest it's been, close to the levels it is today. Here's the big difference, and here's the real conundrum for a lot of investors. Whereas in prior periods of complacency, you knew where the excesses were. You knew where the debt buildup was and how it might correct itself. This time around, a lot of the debt buildup is government debt. And we really have not seen this type of environment outside of wars, when governments tend to borrow to finance the war. And that is what's creating a lot of conundrum for investors, as they know that the complacency is high, but they're not quite sure how it resolves itself.
But so how is it going to resolve itself? I see that you believe the market is going to end lower at the end of the year than where it is now.
Yeah. So I think there are a couple points. Longer term, how it resolves itself, you have to see a higher level of inflation, which will make some of the more safe assets, such as bonds, actually underperform quite significantly if you look out 3 to 5 years. In the short term, the equity markets, I think, resolve to the downside because there are just more ways to lose from here. The valuation multiples are high and could start to compress. The market is anticipating a lot of capital spending, which may not materialize. And then finally, we're starting to see good wage growth, but we're not yet see pricing power, so the earnings growth could fail to materialize. So as we see, there are a number of ways to lose and only a couple to win.